Welcome to the Coin Bureau Weekly News Roundup. My name is Jessica.
And my name is Guy. Here are the top stories in crypto this week.
Germany sells BTC. The German government dumps its remaining BTC holdings on the open market, causing prices to dip. Why the selling might not be over yet.
Ethereum ETF Anxiety. Asset managers eagerly await the approval of the spot Ethereum ETFs as ETH whales prepare to sell. How high or low could ETH go?
Stablecoins Not Securities. The SEC quietly drops its lawsuit against Paxos, opening the door to stablecoin adoption in the US. Everything you need to know.
Yen and stocks. The Bank of Japan intervenes to prevent its currency from imploding, while small-cap stocks rally in response to a cooler CPI. What does it mean for crypto?
And a closer look at last week's top-performing cryptos and where they could be headed next.
All this and more in just a moment. Last week, the German government finished selling all of its BTC. To put things into perspective, it had 50,000 BTC at the start of its selling spree in late June. This works out to roughly $3.5 billion of sell pressure that was absorbed by the market over the last few weeks. The fact that BTC's price held up as well as it did underscores just how strong the demand side of the equation was. And this could clearly be seen in the spot Bitcoin ETF inflows, more than $1 billion over the last week alone. The catch is that most of these inflows could be coming from retail investors. If this is indeed the case, then they may be blindly buying the dip, just like many retail investors are in the actual crypto market. Now, the good news is that Germany's BTC sales are essentially over, so the spot Bitcoin ETF dip buyers have won the battle. But, just as in many movies you might see these days, there is a second wave of selling pressure on the horizon. That is the bad news, the 47,000 BTC that are about to be returned to Mt. Gox creditors. To bring you up to speed, Mt. Gox began returning BTC to creditors the week before last. The catch in this case is that this BTC didn't go directly to the creditors, just to the exchanges which had filed claims on their behalf. Some of these exchanges technically have up to 90 days to fork over the BTC. However, some exchanges such as Bitstamp have announced that they plan on returning Mt. Gox BTC to creditors much sooner. Fortunately, not all these creditors will sell. Unfortunately, the ones that do will probably sell all at once, so this could result in a downside surprise for the market. In turn, this could result in long liquidations. For context, it was fundamentally the long liquidations that caused the market to go down so much when the German government started selling. It was all the traders who went long being forced to sell BTC. And we could see the same phenomenon again. And by the way, we covered the Mt. Gox disbursements extensively in a video yesterday, which you can find here in the top right. Anyways, the silver lining to all this is that if this sell pressure does happen, then it would be an excellent buying opportunity. Not financial advice, of course. The charts suggest that a drop below 56k could be followed by a bigger crash to sub 50k. Conversely though, if BTC manages to get above 60k, it could rally to the mid-60ks and consolidate before moving even higher. If you want to maximize your profits regardless of which way the markets go, then check out the Coin Bureau deals page. It's got trading fee discounts of up to 70% and sign-up bonuses of up to $100,000 on the best crypto exchanges. The link is in the description. And while you're at it, make like Thor and hammer that like button if you're enjoying the video, and subscribe to the channel and ping that notification bell so you don't miss the next one. Now, speaking of BTC whales selling, some of you may have noticed that an enormous amount of ETH has been sent to crypto exchanges in recent days. This could be the clearest sign yet that a spot Ethereum ETF is imminent, and they could already be trading by the time you watch this video. Funnily enough, the launch of the spot Ethereum ETFs could be like what we've seen with the spot Bitcoin ETFs over the last few weeks. Specifically, they could experience significant net inflows, all while ETH whales dump on ETF investors. Where ETH goes will depend on who wins this supply and demand battle. But let's not get too ahead of ourselves. There is a good chance that the spot Ethereum ETFs will be delayed yet again. And by now, you'll know that we believe that asset managers could be coordinating with the SEC to launch the spot Ethereum ETFs when market conditions improve, which would make sense. Not only that, but ETH's price has been surprisingly sensitive to large BTC sales. The same is true for most altcoins. Although ETH and other altcoins didn't fall nearly as much as BTC when these sales happened, most of you probably noticed that it still managed to pull ETH and altcoins lower. Very peculiar. This highlights the fact that the crypto market is interconnected in ways that aren't obvious at first glance. For example, some large crypto investors may be selling their altcoins to keep their BTC long positions open during BTC dips. It's also possible that there's a more systemic connection between them. Come to think of it, it's possible that we could see a similar dynamic when the spot Ethereum ETFs do finally launch. There could be a considerable amount of rotation out of the spot Bitcoin ETFs into the spot Ethereum ETFs. This rotation, plus Mt. Gox sales, could cause BTC to crash hard while ETH rallies. In any case, the ETH charts suggest that it could fall as low as 2,400 if there's another spot Ethereum ETF delay or another bearish catalyst of some kind. It's quite possible that the bearish catalyst could be lower than expected inflows after the spot Ethereum ETFs list, something that could very well happen. On the flip side, though, ETH could rally up to 4K on a successful spot Ethereum ETF listing, and it's possible that the mere news of the spot Ethereum ETFs receiving their final approval could be enough. If this is what happens, though, then be aware that lower than expected inflows upon listing could erase those gains. All we're wondering is why so many ETH whales are selling, and why ICO-era ETH is also waking up and being sent to exchanges. Now, it's important to note that this isn't unique to ETH either. Old BTC has been waking up too. And it makes us wonder if these whales are aware of a very big bearish catalyst coming up. Given that the oldest BTC and ETH was mostly mined in China, it's safe to assume that most of this old ETH and BTC belongs to Chinese investors or miners. Given this fact, it's safe to assume that the bearish catalyst, whatever it may be, is likely related to China and could bite the markets in the coming weeks. More about the possibility that China could invade Taiwan in the description. I digress. Now, on a more positive note, the SEC has officially dropped its lawsuit against Paxos. For reference, the SEC began probing the stablecoin issuer early last year because of BUSD, the Binance-branded stablecoin. Of course, the SEC was looking for evidence that BUSD is a security. Lo and behold, the SEC apparently discovered that this was not the case after over a year of investigation, probably millions of taxpayer dollars, and likely thousands of man-hours. Well, the SEC could have figured this out in 5 minutes if it had actually taken the time to understand what a stablecoin is. For those unfamiliar, for an asset to be a security, it must meet 4 criteria, one of which is that when you buy it, you have an expectation that you're going to make a profit. Logically, there is no expectation of making a profit from a stablecoin. It is literally designed to maintain a stable value. Clues in the name. Regardless, the SEC dropping its lawsuit against Paxos is extremely significant. This is simply because it effectively confirms that stablecoins are not securities in the United States. This means that traders and investors can trade and hold larger amounts of USDC, USDP, and PYUSD without fear of an SEC crackdown. More importantly, it means that traders and investors can also trade and hold larger amounts of gold-backed tokens like PAXG, as they are also technically stablecoins. As such, the SEC dropping its lawsuit should not only result in an increase in US-based stablecoin dominance, but also gold-backed stablecoins. Now, this is where things get interesting. If stablecoins are not securities, then what are they? They're clearly not commodities. So, this means that they must be some form of money. Not surprisingly, this is precisely what many stablecoin issuers have been arguing, and what pending stablecoin regulations would clarify. As such, the SEC dropping its lawsuit could not only result in everything I just noted, but also provide a clear pathway for stablecoin laws in the US. This is just because, like the traders and investors, the politicians will be able to pass these stablecoin laws with the confidence that the SEC won't get in their way. And once these stablecoin bills become law and stablecoins are established as forms of money, then it will be possible to use stablecoins for things like payments. If you've been keeping up with our Solana updates, you'll know that stablecoin payments seem to be its hidden killer use case. More importantly, stablecoin payments would unlock a whole other world of crypto use cases that were previously impossible. For instance, it could become much easier for deep-in crypto projects to gain adoption, as users would be able to pay with their stablecoin-enabled Visa card. Food for thought. Now, as exciting as all of this sounds, it's worth noting that just like the BTC sell pressure, the SEC's scrutiny of the crypto industry isn't completely gone. It's quite possible that we'll see the regulator follow through with its lawsuit against Uniswap and even cook up another Ethereum-related court action. I'll quickly remind you that the SEC was investigating the Ethereum Foundation just a couple of months back. Whatever the case, the fact of the matter is that the SEC will continue to scrutinize the crypto industry so long as Gary Gensler remains in charge. Some would argue that this will be the case so long as Democrats continue to be in power, but there is a case to be made that changing the president would be enough. Anyways, another potential consequence of the SEC dropping its lawsuit against Paxos is that it could give USDC issuer Circle the green light to IPO. You'll recall that the stablecoin issuer has been planning to do this for months, if not years. It's possible that the SEC's stablecoin scrutiny was playing a role in the delay. If this is indeed the case, then Circle's stock could soon list on exchanges, and there's a chance it could someday become the world's most valuable company. This is because Circle ultimately helps governments monetize their debts by issuing stablecoins, which are of course backed by government debt, but used as money. As it so happens, Circle has reportedly been planning to issue a yen stablecoin. If this is the case, then it would come as a great help to the Bank of Japan, which has practically been the biggest buyer of Japanese government debt over the last decade, something that's contributed to the yen's continuing collapse. FYI, the yen has fallen nearly 50% against the US dollar over just the last couple of years, and it recently fell to lows not seen in decades. That's why it was eye-opening to see the yen suddenly rally against the USD when the US CPI came in cooler than expected. At first glance, it looks like this was related to interest rates. In other words, it looks like the yen rallied because interest rate expectations in the US fell in response to the CPI, simultaneously weakening the US dollar. Upon closer inspection, however, it appears that the BOJ intervened. In plain English, it looks like the BOJ sold assets, then bought yen to increase its value. What's fascinating is that this apparent yen intervention coincided with a decline in the S&P 500. This is fascinating because Japanese investors hold a lot of offshore assets, such as US stocks. As such, it's possible that the BOJ sold US stocks for US dollars and then used these US dollars to buy yen. However, it's more possible that the S&P 500's decline was caused by the yen's strength. This is because of something called the carry trade. Investors have been borrowing yen due to its low interest rates and using it to buy other assets such as US stocks. This works well when the yen is weak and rates are low. However, if the yen suddenly strengthens or Japanese interest rates rise, then it makes all this borrowed yen much more expensive. This puts pressure on those who borrowed this yen to sell whatever assets they bought with it, and repay their suddenly more expensive yen loans. The practical effect of this, though, is that it causes the yen's value to rise, which puts even more pressure on those doing this yen carry trade. This runs the risk of turning into a sort of death spiral, forcing stocks to be sold to buy yen, forcing the yen higher, forcing more stocks to be sold, forcing the yen higher still. The unwind of this yen carry trade is something that macro investors have talked about for years, if not decades, and it's possible that we are on the brink of it finally happening. Realistically, though, the yen's sudden strength was likely due to a currency swap. The Federal Reserve printed dollars the Bank of Japan could use to buy yen. The truly fascinating thing is what happened to small cap stocks in the midst of all this market madness. Small caps actually rallied, per the Russell 2000. This suggests that small caps could rally even more if the Fed starts to signal that lower interest rates are coming, which it could do at its meeting later this month. And because small caps seem to be highly correlated to altcoins, this could foreshadow a massive altcoin rally. Case in point, altcoins also saw a bit of strength after the lower-than-expected CPI print came out and interest rate expectations fell. What this means is that alt season could start as soon as later this month. Speaking of which, it's about time we looked at last week's top-performing cryptos. So, Jessica, take it away.
Thank you, Guy. Well, last week's top-performing cryptos were Notcoin, Mantra, Optimism, Celestia, and Ronin. Starting with Notcoin, its NOT token appears to have pumped in response to the news that it had partnered with other crypto projects to create an accelerator fund for Toncoin's growing ecosystem. As expected, NOT is struggling to get above 1.5 cents, which is a key resistance level. If it gets rejected, it could fall as low as 1.2 cents. If it manages to break above, it could rally as high as 1.8 cents in the coming days. Next up, we have Mantra, whose OM token appears to have pumped in response to the ongoing development of the Mantra chain, a Cosmos-based blockchain that will host compliant RWAs. Now, OM seems to be on the brink of breaking above a key psychological level of $1. If it can stay above this level, it could rally as high as $1.3 in the coming days. When it comes to Optimism, its OP token appears to have pumped in response to a technical upgrade to the Layer 2, as well as the recent ECC conference in Brussels. Like NOT, OP is struggling to get above $1.7, which is a key resistance level. If it keeps getting rejected, then it could fall as low as $1.4. If it manages to break above this level, then it could rally as high as $2 in the coming days, a key psychological level. As for Celestia, TIA appears to have pumped in response to the project's recent Modular Summit conference and also all of the associated announcements and developments that come alongside it. Like NOT and also OP, TIA is struggling to get above $7, which is a key resistance level. If it keeps getting rejected, then it could fall as low as $5. If it manages to break above this level, then it could rally as high as $9 in the coming days. Finally, we have Ronin, whose RON token appears to have pumped in response to the sale of Moku NFTs, which seems to have been super successful. As you might have guessed, RON is struggling to get above $2.15, which is a key resistance level. If it keeps getting rejected, then it could fall as low as $1.8. If it manages to break above this level, then it could rally as high as $2.4 in the coming days. If you want to know which cryptos are rallying and also where you can trade them, then be sure to join the Coin Bureau Insider Telegram channel using the link in the description.
And that is all for today's Coin Bureau Weekly Crypto Review.
If you enjoyed it, then you know what to do. Hit that like button, subscribe button, and bell icon too.
Don't forget to check out our deals page where we have massive trading fee discounts of up to 70% and sign-up bonuses of up to $100,000 on some of the best exchanges, only for the viewers of this channel.
Also, if you do want to pick up some snazzy crypto merch, the Coin Bureau merch store has you covered.
You can find the link to that resource and many others in the description below.
Thank you so much for watching, and we'll see you all in next week's episode.